Hello and welcome to Investment Insight. Before we begin, make sure to subscribe and hit the like button. Now let's break down what's happening in the markets today in a clear and simple way. So it is August 2026.
Yep, midsummer.
Right. And depending on where you look right now, you are just seeing entirely different economic realities. I mean, here in the U.S., under the current Trump administration, the focus is really squarely on domestic job numbers and consumer spending and manufacturing output.
Very domestically focused, yeah.
Exactly. But if you look across the Atlantic to Europe, there is just a massive economic shock actively unfolding. And it's not a trade war. It's not a banking crisis. I mean, imagine authorities literally using dynamite to blow up riverbed rock just to keep a nuclear reactor from melting down.
Oh, wow. It sounds insane, right? Like a scene from a disaster movie.
It really does. But it is happening right now. And it isn't coming from some complex financial derivative. It's coming from a single river, specifically the Rhine.
Yeah, the Rhine River. And it really is, it's a huge wake-up call regarding the physical reality of our global supply chains, because we spend so much time glued to traditional financial indicators.
Oh, totally. Bond yields, jobs reports, consumer sentiment, the stuff you always see on the financial networks.
Exactly. But according to recent analysis, the single most critical economic indicator in Europe right now isn't on Wall Street. It is literally just a water level gauge on a riverbank in Germany.
And that is exactly our mission for this deep dive today. We're going to explore how a single, seemingly obscure weather metric is just creating a complete supply chain nightmare. We're going to look at how it's threatening to trigger this really terrifying economic scenario known as stagflation.
Which is the last thing central banks want to see.
The absolute last thing. And most importantly, we're going to break down how this fundamentally changes the way you, the beginner investor, should view your portfolio. Because looking at the data, this really isn't just a bad summer for boating. It is a structural shift in the global economy.
A massive structural shift. And I mean, to really grasp why a river can basically break an entire continent's economy, we have to understand the sheer physical physics of what is happening in the water right now.
Okay, let's unpack this because there's a statistic from the data that frankly just blew my mind. So on August 3, 2026, the water level at the Kaub measurement station in Germany dropped to 24 centimeters.
Yep. The lowest since records began back in 1880.
Right, which is historic. But I have to stop you here and challenge this a bit because 24 centimeters is what, barely ankle deep?
Just about, yeah.
So if a massive industrial barge is carrying thousands of tons of steel, how is it floating in a puddle? I mean, are these ships literally just scraping dirt?
It's a great question, and it's honestly the first major misconception we need to clear up. That 24-centimeter number is essentially an illusion.
Wait, an illusion? How so?
Well, it is just a reference point on a specific measuring stick, a gauge on the side of the river. It is not the actual depth of the navigable river channel itself. Rivers are, they're actively managed.
Okay, so they dig them out.
Exactly. The main channel of the Rhine has been dredged far, far deeper than that gauge's 0 point. So a barge is not sitting in ankle-deep water. There are still meters of water underneath it.
Okay, well that makes way more sense. But then, if the river isn't literally dry, why is this 24-centimeter mark causing such widespread panic across European markets?
Because it acts as this critical price and efficiency signal. Kaub is essentially the ultimate bottleneck of the entire Rhine.
The choke point.
Exactly. Think of a river not like a uniform flat bathtub, but like a natural landscape. The riverbed at Kaub is this shallow, rocky shelf. And it happens to sit right on the superhighway for goods moving from massive North Sea ports.
Like Rotterdam, right?
Right, from Rotterdam down into the heavy industrial heartlands of southern Germany and Switzerland. So if your barge sits too deep in the water, it will strike that rocky shelf.
So looking at the data, it seems like the magic number of survival here is 40 centimeters on that gauge.
Precisely. Once that Kaub gauge falls below 40 centimeters, the commercial viability of shipping just falls off an absolute cliff. Because, a ship's depth in the water is directly tied to its weight.
Right, the heavier it is, the lower it sinks.
Exactly. So to keep the hull from hitting the rocks at Kaub, shipping companies have to drastically reduce how much heavy cargo they load onto the boat.
And the numbers on this restriction are just staggering. I mean, by mid-July, some tanker barges passing through that bottleneck were restricted to carrying roughly 460 tons of cargo.
Which sounds like a lot.
Yeah, it sounds like a lot to the average person until you realize that is only about 20% of their normal carrying capacity.
What's fascinating here is that this is the core mechanism of the crisis. The problem isn't that zero ships are moving. The problem is that the marginal cost of moving anything at all is just exploding.
Right. So let me frame this for you, the listener, because visualizing 400 tons on a barge can be a bit, abstract.
Yeah, it's hard to picture.
So imagine you are moving your entire four-bedroom house across the country. Normally, you just rent one massive moving truck. You load up your couch, your beds, your boxes. You pay one driver, and you pay for one tank of gas.
Simple and efficient.
Exactly. Now, imagine the rental company says, sorry, the highway has a low bridge. You can't use the big truck. Instead, you are forced to use a fleet of compact sedans.
Oh, man. That would be a nightmare.
Right. The physical volume of your furniture hasn't changed at all, but suddenly you need 15 cars, you need to hire 15 drivers, and you're paying for gas 15 separate times. Your physical goods are exactly the same, but your logistics costs just went to the moon.
That is a perfect analogy because
Yeah.
that exact math is playing out on the Rhine right now. Because these barges can only carry, 20 to 30% of their normal load due to the shallow water, companies suddenly need 3 to 5 times as many boats
Just to move the same stuff.
just to move the exact same amount of raw materials. It's incredibly inefficient.
And recent analysis shows exactly how fast that cost gets passed along. By mid-July, the base cost to ship a single ton of cargo from Rotterdam down to Karlsruhe in Germany jumped from 45 euros up to 60 or 70 euros.
It's a massive spike.
And that doesn't even include the low water surcharges that logistics companies are legally allowed to just slap on top of the base rate to cover their inefficiencies.
Right. And, that usually prompts people to ask the obvious question, why not just bypass the river entirely?
Yes. For anyone used to the American interstate system, the obvious solution is rubber and asphalt. If the river's too low, why can't these companies just load their chemicals or their coal onto an 18-wheeler or put it on a freight train? I mean, we see endless lines of trucks on the highways here every day. Why are multi-billion-dollar companies so utterly dependent on water?
It comes down to a mind-boggling scale of volume that roads simply cannot match. Let's just look at the mechanism of fuel transport, for instance.
Yeah, let's hear.
To replace the fuel that normally moves efficiently down the Rhine via bulk barge, you would require roughly 3,000 extra tanker trucks on the road.
Wow. 3,000 extra trucks.
And that isn't a one-time fix. You need 3,000 extra trucks every single day.
I mean, good luck finding 3,000 spare commercial truck drivers just sitting around Europe right now. I can barely get a moving company to show up on time with one truck, let alone coordinate an emergency fleet of 3,000 every single morning.
Exactly. The European trucking industry simply does not have that latent capacity. There aren't thousands of spare tanker trucks and commercially licensed drivers just waiting in a parking lot for a drought to happen,
Right. It's just not realistic.
It is physically impossible to pivot a supply chain of that magnitude to the highway on short notice.
And I assume the rail network isn't doing much better.
No, the German rail network is heavily bogged down right now. They're dealing with severe train driver shortages of their own, and the physical tracks are currently undergoing massive long-term maintenance projects.
So you have a perfect storm. The river is restricted, the highways can't handle the overflow, and the trains are delayed.
It's gridlock. Total gridlock.
So you've got this massive traffic jam on the water. But here's where it gets really interesting. Because the real casualty here isn't the shipping companies, it's what those ships are carrying to the factory floors.
Yep, the industrial domino effect.
Exactly. Let's talk about that domino effect, because looking at the data, some of the biggest industries on the planet are taking direct hits.
The chemical industry is arguably at the front of the line for the most pain here. We are talking about global titans like BASF, Covestro, and Evonik.
Huge companies.
Massive. These are the companies that manufacture the foundational chemicals used to make everything you interact with. Daily plastics, fertilizers, pharmaceuticals, car parts.
But wait, I have to play devil's advocate here for a second.
Yeah.
These are incredibly sophisticated multi-billion-dollar corporations. If they know the river is this huge vulnerability, why are their massive production plants practically sitting in the water on the banks of the Rhine in the first place?
Well, because, historically, the river was an incredible competitive advantage. The river provides two critical things for a chemical plant. First, virtually free, massive scale transport for heavy raw materials.
Right, the cheap logistics.
Exactly. And second, industrial cooling. These chemical reactions generate immense heat, and they pull river water in to cool their systems.
Oh, I didn't even think about the cooling aspect.
Yeah, it's vital. When the river drops, they lose their cheap transport and their cooling capacity simultaneously. When barge capacity drops by 80%, their raw material inventory just vanishes.
And it isn't just chemicals. The data shows that the steel industry is getting absolutely hammered. ThyssenKrupp, which is one of the largest steel producers in the world, actually had to suspend its own barge operations in July because the water was simply too low to navigate safely.
And let's look at how steel is made. You need iron ore and you need coal. These are incredibly dense, heavy bulk materials.
Stuff you really don't want to put on a truck.
Right. They are perfect for dropping into the massive hull of a barge, and absolutely terrible for loading into thousands of trucks. Because they couldn't get enough raw materials up the river, ThyssenKrupp didn't just stop their boats, they actually had to cut production at their blast furnaces.
Which is an enormous deal. You can't just flip a light switch to turn a blast furnace off on Friday and back on Monday, right?
Not at all. A blast furnace is a massive, continuous chemical reaction running at thousands of degrees. If you starve it of raw materials and the liquid metal solidifies inside, you have a catastrophe on your hands.
It just ruins the furnace.
Completely. It takes weeks of time and millions of dollars to safely throttle down or restart one of those furnaces. So for these industrial giants, a logistics spike doesn't just mean paying a bit more for shipping, it literally destroys their physical output.
And this cascades down to the things normal consumers buy, like everyday fuel. Recent analysis from the European Central Bank showed that European diesel refining margins shot up to about 0.35 euros per liter. Why exactly is that happening?
It's a textbook case of artificial scarcity. A refinery buys unrefined crude oil, processes it, and sells usable diesel, right?
Yeah.
But because the river is too low, the barges can't deliver enough raw crude oil to the refinery. The refinery still has to pay all its workers and maintain its massive facility, but it's only producing half the diesel it normally would.
So supply drops, but demand is still there.
Exactly. Because there is suddenly very little diesel available in the region, the price spikes. The profit margin on the few drops of diesel they do manage to produce skyrockets to 0.35 euros per liter. And this directly hits businesses and consumers in southern Germany and Switzerland who really rely on that fuel.
Which brings us to a crucial point.
Right.
While we've focused heavily on Germany and the Rhine, the data clearly indicates this isn't a localized issue. The extreme heat and lack of rainfall is choking waterways across the entire continent.
It's everywhere.
Yeah, the Danube River, the Po River in Italy, major transit routes in Eastern Europe, they're all experiencing historic, crippling lows right now.
And that geographical spread is what transforms a logistics headache into a full-blown pan-European water energy shock. Because, as we touched on with the chemical plants, water isn't just used to float boats. It is fundamentally tied to how we generate electricity.
Which brings me back to the hook I mentioned at the very beginning of the deep dive, the dynamite.
Yeah.
What exactly is happening in Romania right now?
Right. So Romania operates nuclear reactors that rely on water from the Danube River for their cooling systems. The mechanics of a nuclear plant require it to pull cold water in, run it past the reactor's heat exchangers, and then discharge warmer water back out.
Okay, and if the river is incredibly low and already hot from the summer sun,
Then the nuclear plant is in deep, deep trouble. If they pull in hot water, it just doesn't cool the reactor efficiently. Worse, if they discharge even hotter, boiling water back into a shallow river, they will literally cook the local ecosystem and violate strict environmental laws.
so they had to cool it down somehow.
Right. And because the Danube dropped so dangerously low, Romanian authorities had to resort to explosives. They literally blasted away riverbed bedrock to artificially deepen a channel and divert enough water just to keep the nuclear cooling systems functioning safely.
That is true desperation. I mean, you are using dynamite to prevent a nuclear shutdown because the weather won't cooperate.
And it's hitting other forms of power generation just as hard across the board. Take hydropower. Austria's primary electricity provider, Verbund, reported a staggering 370 million euro drop in profits recently.
370 million, just from low water.
Exactly, because river levels were too low to spin their hydroelectric turbines efficiently. In France, EDF, which is their state-owned utility giant, they're expecting massive hits to their profits because, just like Romania, the river waters are too warm to legally cool their nuclear fleet. So they are being forced to just throttle down power production.
So we really have a dual threat mechanism here. On one side, you have this massive restriction in the ability to move goods. which drives up logistics and raw material costs. On the other side, you have a massive restriction in power generation, which drives up electricity costs for those exact same factories.
Exactly. It's a vice grip, which sets up an absolute macroeconomic nightmare for the people in charge of managing Europe's money.
Right. Let's talk about the S word, stagflation. For any beginner investors listening, stagflation is essentially the bogeyman of economics.
It really is.
It's like driving a car with a stalled engine, but your speedometer keeps going up anyway. Normally, if the economy is booming, people are spending money, demand is high, so prices naturally go up. That's standard inflation. Conversely, if the economy stalls out and the engine dies, prices usually drop because nobody is buying anything.
Makes sense.
But stagflation is the worst of both worlds. The economy isn't moving forward, but the cost to live in it just keeps accelerating.
And it is incredibly difficult for central banks to manage because the tools they use to fix one side of the problem actively make the other side worse.
Let's look at the current economic snapshot for Europe, and I want to frame this carefully. If you just looked at a basic spreadsheet, you might think Europe is actually doing okay. The Eurozone actually grew by 0.4% in the second quarter of 2026.
Right. Technically, positive growth.
Yeah, and the July Purchasing Managers Index, the PMI, which measures the health of the manufacturing and service sectors, it hit an 8-month high of 52.0. In that index, anything over 50 means the economy is technically expanding. So, growth isn't dead yet.
But there's a catch.
Exactly. That growth is a mirage if you look at the price tags. Inflation is crawling right back up, sitting at 2.9%, and energy prices specifically have surged by 10%.
If we connect this to the bigger picture, this is the European Central Bank's absolute worst nightmare. The ECB is tasked with keeping inflation low, usually around a 2% target. They held their primary deposit rate at 2.25% in July, but the pressure to do something right now is just immense.
The problem, though, is that the inflation Europe is seeing right now isn't being caused by consumers having too much cash and just going on a spending spree, really.
Not at all.
It's a supply shock. It's being caused by the rivers drying up and the energy grids failing. And as we like to say, a central bank can't print water.
That is the crux of the issue. The ECB only really has one major tool, and that's interest rates. If they raise interest rates to fight that 2.9% inflation, they make borrowing money more expensive. But whacking consumer demand doesn't magically produce more water or fix a broken supply chain.
No, it just hurts the businesses that are already paying 70 euros a ton for shipping.
Exactly. If the ECB raises rates, they crush the very manufacturing companies like ThyssenKrupp and BASF that are already struggling to survive the river crisis. They risk plunging the entire Eurozone into a deep recession.
But what happens if they do nothing? Like if they just leave rates alone?
If they do nothing, the skyrocketing costs of energy and river transport will ultimately just be passed on to the consumer. The cost of everything from a plastic toy to a gallon of gas to the cost of heating a home will permanently increase. Inflation will become deeply entrenched in the daily economy.
Okay, so what does this all mean for you, the listener? We've unpacked the river gauges, the blast furnaces, the nuclear plants, and the central banks. But how does this actualize in an investment portfolio? How should a beginner investor look at European markets right now?
Well, when you face a structural shock of this magnitude, you have to look for the clear winners and the clear losers based on how adaptable they are. According to the data, the most vulnerable sectors are those with a heavy, inflexible reliance on raw bulk materials.
Like the ones we mentioned earlier.
Exactly. We discussed chemicals and steel, but auto manufacturers are also highly vulnerable if this drought drags on. Think about it. A car requires huge amounts of steel, plastics, and energy to produce. If their supply chain is choked at the river, their margins will compress and their stock price will likely reflect that elevated risk.
Okay, so you want to be incredibly cautious around heavy industrials deeply dependent on river logistics. Where is the upside then? Where are the opportunities?
The opportunities lie in adaptation. You want to look for the companies that are actively building the infrastructure for this new low-water reality. For example, maritime engineering firms that are designing and manufacturing low-draft ships.
Low-draft ships.
Yeah, these are specialized barges with ultra-flat bottoms, engineered specifically to carry heavy loads in extremely shallow water without hitting the riverbed.
That makes perfect sense. I mean, if the water is permanently lower, you don't fight the river, you just build a different kind of boat.
Exactly. It also opens up opportunities in companies managing water infrastructure, advanced industrial cooling technology that uses less water, and sophisticated logistics software. Companies need AI and routing software that can dynamically reroute supply chains to trains or trucks the second a river level drops.
And I want to push back on one final thing here, because a skeptic might be listening and say, you know what, this is just a bad summer. Next year it will rain and things will just go back to normal. But the data points to a massive long-term shift, doesn't it? If Germany has known this is an issue, why haven't they just built massive pipelines over the last decade?
Because pipelines are incredibly inflexible and expensive.
Ah,
You can't put bulk coal or iron ore or large manufactured car parts into a pipeline. Barges are historically the cheapest, most flexible way to move heavy things. But you're absolutely right about the long-term shift.
it's not just a one-off event.
No. Over the last 25 years, Germany has lost an estimated 60 billion cubic meters of water. The government's own estimates suggest that chronic water shortages could cost the German economy up to 625 billion euros by the year 2050. They are taking this so seriously that in July, they actually launched a national low water information system called NEUS just to track and predict this ongoing crisis.
Which fundamentally changes how companies have to operate. For decades, global businesses ran on this just-in-time model. You keep your factory warehouses empty, you order parts exactly when you need them, and you rely on cheap, flawless logistics like a deep, reliable river to deliver them instantly. It saved companies billions in storage costs.
But when the river dries up, just in time instantly becomes we have absolutely nothing to sell.
Exactly. So we are witnessing a massive forced pivot to just-in-case supply chains. To survive, companies are now forced to build redundant backup systems. They have to lease expensive extra warehouse space and fill it with backup inventory. They have to sign incredibly expensive emergency retainer contracts with trucking companies just in case the river drops. They have to invest capital in buying new, specialized shallow water barge fleets.
And that redundancy is not free. This is what economists are starting to refer to as climate inflation. It is the permanent structural cost of having to abandon an incredibly cheap, hyper-efficient logistics system for a clunky, expensive, duplicated system simply to survive repeating environmental bottlenecks.
Which leaves us with a final thought for you to ponder today as you look at your own portfolio and your own grocery bills. As global supply chains are forced to adapt to these repeating environmental choke points, whether it's the Rhine River in Europe, low water in the Panama Canal, or anywhere else, are we officially watching the death of the cheap goods era?
It's a huge question.
It really is. Because if multinational companies have to build redundant warehouses, buy new specialized fleets of ships, and maintain emergency truck contracts, that cost doesn't just evaporate. It will ultimately be baked into the price tag of everything you buy. It is a fundamental rewiring of the global economy, and it is happening right before our eyes. Don't forget to subscribe and hit that like button.